My name is Jake, welcome to the channel. In today's video, I want to share with you how we make $50,000 in dividends each year from our dividend growth portfolios. So I'm going to share with you the breakdown of my cash flow portfolio, my real estate portfolio, and my wife's portfolio here in M1 Finance. If you watched my video last week, I shared, an update on our net worth, how we were able to grow our net worth effectively from zero to $2 million in the span of 10 years. And one of the questions that I got a lot on that video was if I've shared, a video on my actual portfolio. And I was thinking, it's been over a year since I've actually talked about my portfolio. So in this video, I'm going to talk about three things. I'm going to give an overview of our $1 million portfolios that we have in M1 Finance. The second part of the video is I'm going to break down and show you the dividend income that we generated since creating this portfolio. And then the third part of the video is I'm going to kind of break it down and humanize this and share with you some of the mistakes that I made. And I'm going to share with you what I would have done different if I could start over. But yeah, once again, my name is Jake. I retired at the age of 37 from my 9-to-5 job. I reached what is called Barista Fire. I created this YouTube channel to help inspire and educate people about the power of dividend growth investing. I'm a pretty normal dude for the most part. I'm a little bit weird and nerdy. I have a 2-year-old. He's going to be turning 3 actually here next month. Been married for a handful of years. My wife is from Germany. We spend part of the year in Austin, Texas, where I'm at today, as well as part of the year up in Utah, where I grew up. And the reason why I'm sharing this with you is not to flaunt by any means. I don't have a Lambo in my garage. If you were to see me on the street, I'm just a normal guy. In fact, you probably think I'm a scrub because of the old clothes that I wear and the old cars that I drive. But that's the reality because I didn't grow up with wealth. I wasn't fed with a silver spoon. And the sad reality for me is that money didn't grow on trees. But if it did, it would have looked a little like this.
Amazing. I can't believe how nice it is. Bye.
Oh my gosh. Oh man. All right, cool. So I want to, I don't really have a script for this video. I'm just, the way that I look at this is as if you and I were sitting in a room, you're sitting next to me, and I was showing you my portfolio. This is kind of what I would say if you were sitting right next to me. But what you're seeing on my screen is actually different than what you've seen these last couple of months or actually years. Is I got a random call from a guy from M1 Finance out of Chicago here the day before. And he was like, hey, just calling in, just checking if everything was okay. And I was like, whoa, this is random. That was cool. And I was like, well, actually, hey, could you update my dashboard? And they were able to update the dashboard to revert back to the date. So what happened is I transferred over a portion of my portfolio that I had in Vanguard in my taxable account, and it reset the timeline here on the dashboard. And so they were able to reset it back to when I opened up the account. I opened up the account with $200. The first investment that I made, invested $199.83. That was the first day that it invested the money that I set up into the account. And like many of you likely, when I was first hearing about M1 Finance in 2019, I was like, wait a minute, is this a scam? Like, what is this? Like, can I trust these guys? And so I first initially set up the account with $200. And then after a couple of months, I transferred over a balance that I had in Robinhood. I was using different brokerages and I wanted to consolidate. And so I transferred over a handful of positions, I think like Coca-Cola and, PepsiCo, stuff like that, waste management. And so I transferred over that shortly after using M1 Finance because I was a pretty big fan of it. I thought, hey, this makes sense. I like what I'm seeing and it worked for me. And while I was working in 2019, 20, 21, up until I was laid off here in 2023 from my job, I was transferring money into my portfolio every single week. Okay. And, it was kind of boring, right? Just every single week, just transfer money into it. And that was kind of the end of it. And then, so I made 2 transfers. I made one transfer in from Robinhood in 2019. I made another transfer of another brokerage in 2021. And then this other spike that you're seeing here, if you've watched some of my other videos, I sold, we sold one of our rental properties, and then I just dumped it all into my M1 portfolio. Unfortunately, right at the beginning of, kind of towards the beginning of 2022, right before the market dropped like 30%. So my portfolio has been pretty stagnant right here. I have not invested any money. I stopped reinvesting my dividends, no new capital. So when you're seeing this kind of be stagnant, that's just the portfolio, no reinvested dividends and no additional money into the portfolio. And the important thing here is I never had the goal to really get wealthy overnight from picking the right stocks. My strategy was always, well, I'm going to go and try to get a good job, try to side hustle, maybe make money on the side with real estate, and then I'm going to take the money and then put it into my portfolio. A lot of people, a lot of things that you hear here on YouTube is a lot of people try to sell you the idea that you're going to grow your net worth by picking the right stocks and buying in and out of the stock market. Now, kind of looking at Bitcoin and growth stocks this year, I mean, that's definitely worked, but that was never really my strategy. What I tried to do was invest into a strategy that I could stick with, that wasn't emotional for me. And I really focused on a buy and hold strategy. And the core focus of my strategy was, how do I get more money into the portfolio versus just trying to grow it from the portfolio, right? Does that make sense? I'm going to say that one more time, so just that I can understand it and hopefully it comes across clear. My goal was never to 10x my portfolio from within my portfolio. My goal was to 10x my income, my invested income outside of my portfolio and bring it into my portfolio. Okay, do you follow me? So that was always my strategy. I never really wanted to pick the winners and put all my chips on black or red and try to win that way. I tried to get money into it. Okay, so that's how I viewed this, and that's how I was able to build my wealth. There's many different paths that work, right? It just depends on you and your skill set and your patience and your what you're trying to accomplish. And so over the lifetime of this portfolio, I'm up with the dividends. I'm up about 80%, a little over 117,000 in market gains and 91,000 in dividends earned since the portfolio was set up. So that's my portfolio. This is my cash flow portfolio. I have 22 holdings in here. I follow, for the most part, the core and satellite, where my ETFs are my core and my satellite positions are my individual stocks. And so how I have it set up today is my largest holding is actually JEPQ because of the growth in it. It's done very, very well. This is a covered call ETF. I really am a huge fan of JEPQ. My focus here is more on income. I'm not really focused as much on growth because I'm living off of the portfolio today. If I had a long-term time horizon, this would look very, very different. Or if I was just getting started, this would look very different. Okay, and I'll touch on that here towards the end of the video, what I would do differently. My largest holdings are, JEPQ, VYM, SHD, JEPI, and DGRO. These are, kind of how I see my core holdings. And it's really specific to me because my goal is to live off of the income today. So that's why I have it set up that way. If I were, just as an example, if I were to have like 10 years or 20 years out in the future, I'd have no cover call ETFs. I'd have heavily skewed into SHD, DGRO, a little VYM, and then my individual holdings. Okay, so it's important that you understand that the way that you invest, you don't want to just come and copy this, because if your goals and time horizon don't match my time horizon and goals, you're going to be in kind of a mess. For taxes, for optimizing for growth, it's not really a smart thing to do. So if you haven't watched those videos that I've made on how to invest based off your investment time horizon, I'll leave a card here in the top right. You can click that video and watch that video next. That'll make sense. But essentially, this is how I have the portfolio set up. And I've adjusted this and changed this so many times over the years. Not in the last year, I haven't changed anything, really. I think I've sold out of one company. But other than that, I've made no changes over the last year. Back in 2019, 20, 21, I was still figuring things out. And so I was making a lot more changes. What I landed on was my satellite positions. I don't really want to have to follow up on them as much. And so I just have them equally weighted. If, for example, you know, I don't know, Southern Company or Duke or JM Schmucker were to cut their dividend, I probably would sell out of them. Right? That's where I'm at today. I would sell out of Duke if they cut their dividend. I'm not saying they are. I'm just saying hypothetically, or Procter & Gamble or any of them. If any of my positions were to cut their dividend, I would sell them from my position, and I'd probably either put them in one of my ETFs, DGRO, SHD, or JEPQ, something like that. So when looking at my satellite positions, you know, you'll notice that I have a combination. I have a high yielding company here like Altria Group or British American Tobacco. You know, I'm not the biggest fan of sin stocks. If I had more money and if I didn't need the yield, I would sell out of those today. But I do like the tax treatment of these higher sin stocks. I don't plan on keeping them forever. This is more a means to an end. If I had more money, I would sell out of them. That's kind of, it's important that I make that point because it's not like I'm not a smoker. I'm not a fan of smoking, but I am a fan of people having the choice and if they want to smoke, the freedom to do that. I'm a huge fan of that. It's not like I have any emotional connection to these other than I guess Costco. I go to Costco like once a week. You'll notice here, the point that I'm trying to make is my satellite positions serve a purpose to balance out my goals, which is a combination of current yield, which I'm getting through these higher yielding dividend stocks like Altria Group, AbbVie, for example, and more of a dividend growth focus where I have Lowe's, Waste Management, Costco as an example, right? So through that balanced approach, I'm getting a good mix of current yield plus a good dividend growth. It's important that I still have growth in there so that I'm outpacing inflation. And the last time that I ran the numbers, I'm getting around a 6% weighted average of dividend growth. It's kind of hard to measure that with the covered call ETFs because they haven't been around. It's kind of hard to backtest them, and it's kind of hard to predict the future, what the market will look like with volatility, et cetera. So conservatively, this portfolio has about a 6% dividend growth rate. And the current dividend yield is around, I believe, 4%. You can check out the dividend yield. I will leave a link in the description below to this portfolio if you want to check this out and see the individual holdings. There's a link in the description of for my portfolio. And if I go and I look at the history of my portfolio, you'll notice here, you know, some of these are paying monthly. The cover call ETFs pay monthly. I love that, especially when you need income in early retirement. It's huge. Others are going to pay quarterly. You know, you'll see here, Costco, I got $29 from Costco. That's not going to move the needle for me. Sometimes I look at the growth that I have in Costco and I'm like, I could sell that and I could buy Altria Group or more JEPQ and get more yield. But, it's just, I want a balanced approach for my overall portfolio. And so here's the dividends that I'm getting. The thing that I really want to show you is kind of like, let's take a look at SEHD. So my last payment in December was just over $1,000. When I first started investing into SEHD back in 2019, I got 60 cents, guys. Like, really, you have to start somewhere. Okay. And if you watched my video from last week, you know that I sold out of most of my stock positions in 2019. Do you remember that? And what did I do with it? I put most of the money into that real estate, those 2 real estate properties. And then I ended up selling them 2 years later. And then what did I do then? I then took the money and I invested it into my portfolio. You see that? We're coming full circle here. Remember the beginning of the video, how I told you that my focus was always making my money outside of my portfolio and then bringing and focusing there and then bringing the money into the portfolio? That's how I focused on building building, our income and our net worth is through that. And not so much, having a portfolio full of Bitcoin, though that would have been really great looking at Bitcoin today or Nvidia or these growth stocks. That was never really my goal because I was never really good at that. I could never time the market. I was too emotional. I'd always sell out too early or too late. So I never really tried to do that. I tried to do that earlier, when I was younger, and I failed miserably. And I learned from me that wasn't going to work for me. And it works for other people. It just never worked for me. So I didn't do that. And then looking at another one here, VYM, for example, very, very similar story with VYM is with SHD. Another one that I wanted to show you is JEPQ. You can see here, the distribution from JEPQ is pretty sporadic. It's kind of all over the place. It's a little bit difficult to plan with the income from JEPQ. It's just simply how these cover call ETFs are set up. The last one here that I wanted to show you is with waste management. I didn't invest a lot of new money into waste management. I invested into waste management early on, and I didn't really invest much more. Now, if I would have had a longer term time horizon, this stock would have been one of my highest positions or one that I funded a lot more. Instead of being at 2% as a satellite position, it probably would have been at around 5%. That's just how I see this company. This is one of my favorite. Next, I want to take a look at my real estate portfolio. I set this up years ago, back in 2019. The idea here was I wanted to separate the qualified versus the non-qualified dividend. It didn't, at the end, when I added those cover call ETFs, it kind of defeated that purpose. But my initial thought was to separate qualified and non-qualified so I could kind of calculate them differently and measure them differently. But I, was adding to this portfolio. I made a few changes over the last couple of years. In the last year, I didn't really make any changes. But I'm thinking about making one or two, and I'll share that here in a second. Similar to my other portfolio, when we sold the house, I dumped some money into this portfolio, I think like 30 or 40,000 directly into the portfolio. Once again, right before the market tanked like 30%. And then, in 2023, I stopped funding the portfolio. I really, really wish I was still working and I could have, dollar cost averaged into this portfolio. I really, really wish, it would be so far up and to the right if I could have still reinvested the dividends and invested more. But, you can't time everything. That's just how it works. So I am definitely down on this portfolio. I only have I only have 8 holdings in here. I got VNQ, the Vanguard Real Estate ETF. I have Realty Income. I got DLR, Data Center REIT, Stag. Really like Stag. It's a industrial REIT. Omega Healthcare. I'm kind of on the fence with Omega. When I invested in Omega, they were raising their dividend. This was before the pandemic. Then the pandemic hit. Thankfully, they didn't cut their dividend, but they haven't grown it. And so I don't know, I'm just kind of on the fence. I do like the future with the baby boomers getting older and, the space that they're in. I think there's a bright future. I don't know, that dividend, they lost like 10 years of dividend growth, and it is what it is. My favorite REIT is Prologis. If I could, if I were to only have one REIT, if I only had the choice, it'd either be Realty Income or Prologis. I'm such a huge fan of the industrial space. I only see it growing, right? This is a really, really great one. American Tower, I like it. They did acquire another, a data center REIT. I do like American Tower. I'm a little bit questionable. I need to do more research. I haven't researched this in over a year on what Starlink and how space is going to impact cell towers down on Earth. Maybe somebody who's smarter than me that's followed up on this can kind of educate me on that. But I want to see how space and satellites in space are going to disrupt satellites here on Earth. And so that's been a question of mine. How is that going to be potentially disrupted? So I don't know. We'll see. And then the last one, MPW. This was my golden child of 2021. And then it just, oh man. So my thoughts on MPW, I've shared this in the past. MPW, I have decided I will be selling MPW. The question is, do I sell it this year or next year? I'm going to try to, I'm in no rush. I'm going to hopefully try to see if I can recoup some of the losses here. And I plan on selling it for a, capital gains loss either this year or next year, probably next year. But I have made the decision that I will sell MPW. It's a question of when, not if. If the facts change, I'm able to change my mind. And the facts have definitely changed despite, what's going on with the shorts, despite I just don't want the stress in early retirement. Why? I don't want it. So it could be the best business in the world if in early retirement, I've noticed I value more the sleep well at night, and this is no longer a sleep well at night. So that's my opinion on it. Somebody might have completely different views on it, and that's completely fine. You can buy my shares. That's cool. And so we're looking at the dividend income. You can see here that, this one has really started from humble beginnings. I always, transferred a smaller percentage into this portfolio while I was working. It only grew up to about a little over $100,000. The dividend income is going to be, it's just going to be lower. But the thing that I want to show you what hurts is this MPW. This is what hurts me. Went from making $300 to $157, so 50% less. It's just, when you're in early retirement, I'm a little bit unforgiving. I mean, if they cut my dividend, one that I wish I would have built up more, hindsight 2020, but I definitely wish I would have bought more Prologis earlier, before the pandemic. My thinking when it comes to real estate, I want to invest in real estate that cannot be as easily disrupted. Okay. And so that's how I view it. And that's my dividend portfolio here, my real estate portfolio here in M1. The last one here is I want to show my wife's dividend portfolio. I haven't showed this on the channel, I think, in over 2 years. I need to bring her back and have her actually come in and talk with you about her portfolio. But you'll notice here, she started her portfolio a couple months after I started. She was investing, I think, like $10 or $15 a week, not very much. And then when we sold the house, we lump summed invested into her portfolio and again. And so she's skewed a lot more in growth, and her portfolio is a mixture of growth and dividend growth. Okay. And it's just so cool. She loves looking at this on her app, and she loves making fun of me because hers is only up and to the right and mine's been a little stagnant, but they're focused a little bit differently. And so she loves it. If you are married or you have a girlfriend, boyfriend, and you're thinking about getting them invested and you want to help them to start getting invested, this has been, such a game changer for my wife to have the app on her phone. She is so emotionally invested into this because she got to participate and pick some of the positions in her portfolio. And then she leaned on me for the other positions in her portfolio. So we have it set up where we have dividend growth ETFs at 70%. We have my wife's favorite stocks that she likes here at 20%. And we have dividend growth stocks that I selected as well. So she didn't want to manage everything. She just wanted to pick about 20%. And, I did the rest. And so let me walk you through how we have it set up. In the ETFs, we have it pretty straightforward. We have JEPQ, SHD, JEPI, and DJRW. I really like DJRW. I like the monthly dividend income. In 10, 20, 30 years, this is going to be, just a cash flow king, just pumping out dividends from just how the ETF is set up. So this is more future looking in terms of how we have it set up, much more skewed towards growth. Okay. And, we have SHD in there. We didn't put DGRO because we have DGRW and I have DGRO in my portfolio. So I'm fine with that. I wanted to, I'm trying to get her more of a monthly dividend so that she has reliable monthly income and that she can budget more so with a monthly dividend. And then let me show you the dividend stocks that I picked, and then I'll show you hers. For the ones that I picked for her, I got Realty Income, Coca-Cola, PepsiCo, and Waste Management. So just 4 dividend stocks in there, equally weighted. Pretty straightforward when it comes to that. When it comes to hers, this is what she's really excited about, what she loves. So she's got Microsoft, Costco, McDonald's, Target, Sony, Honeywell, Netflix. She bought Netflix like right when it tanked. I think it was like $300. I think she's up over 100%. So she's proud about this one. She's got Salesforce. I was going to try to get her to sell Salesforce, but now that they're paying a dividend, I'm actually thinking, you know what? Let it ride. Hold it forever. We'll see. Amazon, NextEra Energy, and Google. So these are the ones that she has in her portfolio. She has the growth in there. The plan was always that she was going to invest into growth, and once we retired, she was going to then transition from the growth, sell for a capital gain, and then rebalance into more of a higher dividend. And that was always the goal. And that's how she set up her portfolio. But, you know, I don't think she's going to sell any of these growth stocks anytime soon. I mean, she just loves them. And another tip really quick, if you're, you know, struggling to get your spouse, friend, significant other invested into the stock market, what I'd encourage you to do is have them look at their favorite brands, something that they use that they're a consumer of, and have them invest, you know, a small percentage into those stocks. For example, the way that I started, I was like, well, what's your favorite company? And she said, well, Sony. Well, because she's a big nerd. She plays, I think she's playing like Elden Ring or something right now. And I'm sitting on my computer over here and she's over there, you know, at night, and she's like screaming because she keeps dying in Elden Ring. Oh my gosh. So yeah, she's a big Sony fan. She's a big nerd. So yeah, it only made sense, right? Is Sony the best stock to invest in? I don't know. Maybe, maybe not. But it gets her excited about investing, and it gets her excited to invest into these other, you know, stocks and ETFs as well. So anything that you can do to get your friend or spouse or whoever to get excited to then start and then stick with it. Because here I got her excited back in August of 2019. And you know what got her excited was this. This kept her excited, right? Seeing the growth in her portfolio kept her excited. So get them, this is how you get them. You get them excited in the beginning, and then they're going to see the growth. And as they automate and dollar cost average each week into their portfolio, it's just amazing. So that's my wife's portfolio. So next I want to walk you through how the dividend income changed over time. So it doesn't show the years, but this is June 2019. And if you remember from that last video and what I was saying earlier in this video is we didn't have a lot of money in 2019 to invest in the stock market because we sold the majority of it and we invested into 2 rental properties. Okay, so the money that we had in our brokerage was pretty low actually. And we started growing it through our W-2 and, you know, through our day jobs. And so we were investing, and, you know, I still remember getting like 60 cents from Coca-Cola or Waste Management or PepsiCo, like those pennies, right? But it didn't matter. It got me so excited, and I kept doing it. I kept going. And in the first year or two, I really made a lot of mistakes. I would buy and I would sell, and I thought that I could, you know, kind of change this up. Ultimately, my strategy changed quite a bit. And it's pretty normal for your strategy to change as life changes, right? And so I can't really say that I would have done it differently. I did the best that I could with the information that I had. But if I could go back with the information that I have today, I would do things differently, and I'll share that here in a second. Yeah, you'll see here that the dividend income, this is with all of our portfolios. You know, with my wife's portfolio, like in the beginning of 2020, she got like $2 a month, right? So nothing. And so slowly but surely, we saw the portfolio grow. And you'll notice here, kind of in this range right here, that it's kind of fluctuated up and down. A lot of that has to do with the covered call ETFs. Covered call ETFs are not like, you know, AbbVie or one of these dividend aristocrats that are growing, you know, quarter over quarter, year over year. It fluctuates a little bit more. On average, we're getting right now about 4,200 a month spread over the quarter, right? Spread over the year, about a little over 4,200 a month. And what that looks like on an annual basis, you'll see here in 2019, the first year we made not even $500 in dividend income. And then you'll notice here in 2020, we didn't even make $3,000, right? But for us at the time, $3,000 was like, yes, we're on our way. We see the light at the end of the tunnel, kind of, right? Like we were so excited. 2021 was a big year. We increased the amount that we were investing significantly because we got pay raises, changed jobs. If you didn't watch that video last week, I talked more about that. But in 2022, I was making really good money. My wife was making good money. We transitioned the money from real estate into our portfolio, part of it. And we had a good year. We made over $40,000 in 2022. And throughout 2022, we were still funding the portfolio. In 2023, I didn't reinvest any dividends and I did not add additional money to my portfolio. It didn't really grow significantly year over year because I wasn't investing new money. And I anticipate only about 4 to 5, maybe 6% growth in 2024, just organic growth. So I'm projecting around 53,000 here for 2024. But you'll notice once you stop working and once you start living off the dividend and not reinvesting, it slows down quite a bit. But this has been our journey. This has been our path to generating $50,000 in income here in 2023 from, all three portfolios, which totaled $1 million. Now I want to walk you through what I would do differently if I could start over, if I could time travel back to 2019, some of the things that I would have done differently. So first off, how I generated the money, I probably would do the same. I would still try to focus my energy on making more money, cutting my expenses outside of my brokerage and focusing my energy there to then bring the money into my portfolio. I probably wouldn't do anything really different there. Maybe what I would do different is invest into like a high growth ETF like VGT or VUG on the side and have that on the side to, then once I reached retirement or the goal, right? To sell that and then rebalance into my dividend portfolio. Do that as a portion. I probably would have done that. I wish I would have done that as well. So I did it through real estate. It worked well. It was a lot more sweat equity and hard work. Probably would have been easier to invest a portion into a growth ETF. I would never do it with individual stocks. I'm just too risk averse for that. I would have more so focused on like VGT, VUG, growth ETFs, and had a portion, there. So that's the very first thing that I would have done different. But the next thing that I would have done is it's hard to say I would have done things differently because, I didn't have this information at the time, but I wish if knowing what I know today, what I would do different, I would not mess around with this whole trial and error thing. I tried to over-engineer my portfolio. If you watch my old videos from years ago, I tried to over-engineer things. And it was just too much. It just wasn't, I realized that simpler is easier and better. And I thought I could, do this all myself and effectively create my own index fund with M1 Finance by having dozens and dozens of individual stocks. I learned for me that wasn't the right decision and I changed that. Okay. And I was trying to focus on the perfect mix of, the perfect balance of, exposure to different industries like telecom, healthcare, manufacturing, CPG, retail. Like I realized if I use the core and satellite approach to investing, I don't need any of that. I'm already getting optimal or great diversification through different sectors and industries in the market through my ETFs, through VYM, SHD, and DJRO. And so I didn't realize, because I didn't really have so much exposure to ETFs in the beginning, I had to do it myself. And I realized, holy crap, this is so much more work, so inefficient. And then by adding ETFs, I immediately got diversification. And so if you watch my old videos, like from years and years ago, you'll remember maybe that I had different pies for different industries. And I know some YouTubers do it today, but I don't think you need it anymore. Because I follow the core and satellite, that's why I don't have industry-specific pies. Because I have the exposure through these ETFs. Does that make sense? And so I wish I would have understood that back when I first started. And I guess the last thing, knowing what I know today, what I wish I would have done when I first started is follow what I talk about on my channel today. What I talk about on my channel today is the core and satellite. Between 60 to 80% of your portfolio are in high quality dividend growth ETFs like SEHD and DJRO. I wish I would have started that way and then slowly built out and added more, VYM, JEPQ, added those later. I wish I would have started with like 10 holdings. SEHD, DJRO, Costco, Lowe's, Waste Management, maybe a Union Pacific or a PepsiCo or something like that, a Coca-Cola. And then slowly, as I learned more and as I understood more what I was trying to accomplish and my goals, because your goals change, that was the problem, is I didn't really understand what my goals really, really were back in 2019. The time frame, at least. I knew my goal was always to reach fire, but the time frame, I didn't really understand how to invest based off of your time horizon. And so that's what I would have done differently. Knowing what I know today, I would have had a portfolio of maybe 10 positions, 10 holdings, SEHD and DJRO. I probably would have had 70 or 80% into SEHD and DJRO and had maybe 8 individual holdings, maybe equally weighted, maybe 4 or 5%. That's how I wish I would have gotten started. And then as I got closer to my goal and as my goal became more of a reality, I would have then slowly, year by year, adjusted my portfolio, kind of like a target date fund. I would have adjusted the holdings, added additional ones so that they met met my goals and what I was trying to accomplish. That's what I wish I would have done. And once again, I wish I would have stuck to, the 5% in one individual, no more than 5% into one individual holding. That's why I talk about it so much, guys. I know I sound like a broken record, but it's, I'm not that old, but hopefully I'm a bit wiser than I was when I first started. That's what I learned, the core and satellite, and make sure that no one individual stock is more than 5%. If you do that, you can have catastrophes like MPW and still be able to sleep at night and still be able to go on and not have to worry or stress about, not being able to fully retire and having to go back to work. That's what I learned. That's what I wish I would have done earlier. I hope that this video was helpful. I hope that it gives you insight into how I view this, some of the mistakes that I made, some of the things that I learned. If you are hearing this idea of the core and satellite, and the simple path to wealth, if you've never watched that video on my channel, it's one of my favorite videos that I made on my channel. It's called The Simple Path to Wealth with Dividend Investing Using the Core and Satellite Approach. It was inspired by J.L. Collins. And I think if you've never heard of that or watched that before and you're looking or thinking about building a dividend portfolio to one day live off of, I think that video will help you a lot. So I'll have that video pop up here in a second. But yeah, thanks for watching, and I'll see everyone in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.